시장의 초점이 트럼프 대통령의 관세 정책에서 감세안으로 이동하면서 금리 그리고 채권 시장이 주도하는 장세가 됐습니다. 무디스가 상기시킨 미국 재정 지속 가능성 우려에 셀 아메리카 내러티브가 재부상했고 장기 금리도 뛰면서 주식 시장마저 영향을 받고 있는데요. 금리의 향방이 어떻게 될지 위즈덤 트리에서 55조 원 넘는 채권 운용을 책임지고 있는 케빈 플래너건 채권 전략 총괄과 릭 하퍼 채권 CIO를 직접 만나 이야기 들어봤습니다. Okay, so thank you so much for your time today. At the time of this interview, Trump's tax bill managed to pass the House today. So it sent the long-term treasury rates higher yet because of the concerns over the fiscal deficits. So mixed with the Moody's recent downgrade, of course, I don't know if you guys really give some weight to that, but mixed with all those things, how do you expect these recent events to impact treasury valuations or demand or everything?
Well, what's interesting is that, there was two parts of the Trump administration coming in. There was the tariffs, and then there was what we call the big beautiful bill, what you referred to. What's interesting is right after Election Day, the initial reaction in the Treasury markets was negative. In other words, yields moving up because there were concerns about the tax and spending kind of proposals that we could see. And you actually had the 10-year Treasury yield going to 4.8% in mid-January. Now, you fast forward that to April 2nd, Liberation Day, and that created a different environment where you saw a risk-off trade and the 10-year Treasury yield plummeted. So at that point, the traditional hedge Treasuries can be as a risk-off instrument came into play. But we would be talking at a committee meeting and to our clients that the conversation will change back to the big beautiful bill, back to traditional fiscal policy, and that's what we're seeing now. And I think the reaction in the market, which was interesting that you mentioned earlier, was what we call knee jerk, so an initial response, negative yields going up. But as we're speaking right now, the 10-year Treasury yield is actually unchanged or a little bit lower from yesterday. And I think the bottom line, and I think something Rick and I tend to reinforce, is the ultimate determining factor is going to be the fundamentals. Where is the economy, the labor market specifically? Where's inflation? How does the Fed respond to it? And typically supply issues, concerns about the deficit, are more secondary in nature. They can add to or take away a trend.
Yeah, I think it's not necessarily a question of fiscal sustainability. It's just exhaustion in terms of, are we ever going to see fiscal discipline? And that's kind of gone away from it. And I think one of the things to bring up about the Treasury market's reaction, eventually after the knee-jerk, you get back to the fact is a phrase we like to call TINA, there is no alternative, right? There really is no alternative to treasuries within the global market at this point. I know it's a big headline in both the Moody's and the budget. The budget's got a long way. It's not going to have an easy fight in the Senate. And it's sort of like, just calm down. Everyone just calm down. This is not necessarily a doomsday scenario.
Can we talk about the Moody's action for a minute? I think it's very important to what Rick was saying to put it in perspective. This was not a surprise move. Moody's had telegraphed this a month, 2 months ago in a relatively recent report, and the U.S. credit rating was on negative outlook. So really Moody's just joined Fitch and S&P by bringing the credit rating down a notch. And what's interesting from that vantage point is now all three have the U.S. at a stable outlook. So it's not as if the downgrade came and then it was like you're still on negative. They bring it back to stable. S&P downgraded the U.S. almost 14 years ago, right? So, and nothing has changed since then except, from their perspective, that you're seeing stable become negative yet. Could it? It possibly could. We don't know. But it's not this Armageddon type of situation we're worried about. Matter of fact, if you were to look at some of the numbers that are thrown out there, a lot of economists that I've read for the budget deficit for next year, next fiscal year, it may increase by 130 billion. That's not a game changer. And everyone tends to talk about 3 to 5 trillion That's a 10-year forecast number that it's just 10-year forecasts, right? Who knows? But that's where we are right now. That's kind of the environment, some of the volatility, and I would say some of the sensitivity that you're seeing in the markets at this stage of the game, which to me, once again, gets to Rick's point. There is no alternative. Where are you going to go? We're not seeing massive foreign selling or anything like that. And if you look at the global ag, AAA universe, treasuries outstanding, marketable debt outstanding, is 3.2 times the size of it. So there is, where are you going to go if you have US dollars? You're going to continue to put your money, we would argue, in the treasury market. And it's not just us saying it. Rick threw the name out, I don't know if you caught it, Schlegel. It's not just us here in the US mentioning it. I think it's important when you hear someone overseas, especially a central bank official, also agreeing to that.
As you guys entered, you said the rates are normalizing. It's not like a Armageddon doomsday kind of scenarios.
It is kind of funny that we're some of the more mature members of our team.
Seasoned?
Seasoned. That's a good word. And we started in the 80s and 90s. And so this is historically what we've seen for rates. They've traditionally have a 5 handle, and you kind of get in. And a lot of our colleagues have never seen a 5 handle. And obviously, so this is a return to the normal that we've seen. Zero interest rate policy is in the rearview mirror, but it dominated for over 10 years.
Well, right, that's important, right? It's the perspective. So if you look at, say, U.S. fixed income yields, whether it's treasuries, investment grade corporates, securitized, high yield, and you look at a period, say, from 1988 to right up to the financial crisis, yield levels were really close to where we are now. And it was that period in between, right, from the financial crisis through COVID, where you would have what we would call abnormal rates, to Rick's point, because you had zero interest rates, you had quantitative ease, you had negative interest rates abroad. But the key to all of that, though, let's call it market participants, investors, traders, hadn't seen anything else, a lot of people.
But some would argue then and now, the big difference is the U.S. debt amount. Now it's more, the U.S. government is paying more than the military cost.
What's interesting is in response to the Great Recession and the financial crisis, we were actually running for a couple of years deficits over $1 trillion, right? And it was during that period, actually, from, as I was saying, kind of like financial crisis to COVID, that you still had, increasing treasury supply, but interest rates still, you had at one point the 10-year note at 0.54% hit, even with deficits. So it gets back to the point of the fundamentals are the primary driver, and then you go to the deficit. But as Rick said, at some point, you get asked, is it sustainable? No. I mean, theory would tell you this isn't sustainable, that at some point, you're going to need to have perhaps to address this. But then again, is it just the U.S.? Look what Germany just did. Germany just, what do they call it? The debt brake?
Yep.
They kind of blew their debt brake up. So it may be we're just seeing this very important aspect that it's not just the U.S. where the fiscal policies or fiscal outlooks are going to potentially raise deficits in supply. And if you look at spreads right before we came in here, 10-year bunds, German bunds, 10-year treasuries is, say, around 195 basis points. So the difference in yield between the two, right? And it's kind of like where we've been. So you're not seeing any kind of significant or visible shift that people keep talking about, sell America. You're really not seeing that.
So if to sum it up, you guys would love to see some fiscal discipline. Too bad it's not now. But that's why the yields have gone up. But it's not the end of the world. It just returned to normalcy. Everything is okay.
It's not right. I mean, and you have a Federal Reserve who are sitting back and waiting. right? They're, Powell said it perfectly. This is not the time to be preemptive. They're going to be reactive to what we see. So this all plays into the mix of treasuries.
If I just want to go to the fundamentals, what you mentioned, when Trump was first elected, there was, of course, this is the stock story, but the stock market guys were very much anticipating the tax cut because it was seen as very pro-market and pro-growth. But now, of course, it's the time of the bond, so it's very much about a fiscal story. Do you think the tax cut is going to be, as the Trump administration says, it's going to be pro-growth? It's going to be great for the fundamentals?
My first thought is the devil will be in the details, and you can't make too many big assumptions by what just passed the House, because what eventually might get passed could be very, very different. And it could be that you kind of dig in, and it's not the first day, it's not the second day, but a week or so later, you find some little provision in the bill that's like, oh, this is not good, or this is great. Yeah, it's kind of, so I think this uncertainty is going to go on for some time, and we can come back to later in the ramifications of that.
And remember, what's at the heart of the House legislation? It's renewing the tax cuts from 2017. Yeah. It's not as if we're getting new ones. Sure, taxes on tips or things like that were included, but in terms of, did you see the corporate tax rate get dropped? Yeah. Did you see individual tax rates move lower than where they are? It's more or less the status quo. Perhaps the way to look at it, instead of it being a significant pro-growth, what would have happened if they didn't do it and the tax cuts were going to expire at the end of this year? But is it the catapult to take us to the next level for economic activity? That's up for debate.
What I'm confused of is the market narrative. What does the market want? Does it want more tax cut? Does it want less tax cut? What is good for the fundamentals? What's the sweet spot?
Theoretically, right, tax cuts are good, but we're at the point now where, but how are you going to pay for it? So that's the mindset now. 6 months from now, maybe that's not the mindset anymore, right? If you start to see that the impact on the deficit is not earth-shattering, and it's not worrisome, and the spending part is going to be the interesting thing, I think, to what Rick was saying, for the Senate. The Senate seems to be a little bit more hawkish on that. They want more spending cuts. So we're still, we're not there yet. Okay. Yeah.
So on your most recent April paper, I think you mentioned that the 10-year yield could move toward either 3.5% in a hard landing scenario or above 4.5% on a risk on trade. Where do you see yields heading now?
Well, basically our position since the beginning of the year has been we've been relatively neutral on taking on additional interest rate risk relative to a benchmark, right? And the uncertainty that's persisted has not really encouraged us to move from that position. While we'll talk amongst ourselves about a 10 or 20 basis points move up or down, we're really not making decisions based on that. And I think the one thing I think it's important to key on, we haven't talked about this yet, but I think the housing market is one thing the administration is extremely focused on. Just look how many times they've mentioned 10-year yield. The 10-year yield is code for the housing market. And they know the higher the 10-year yield, if it gets up till near 5, you might see some signs of pressure on the housing market. So that's sort of the upper side of where we've seen things. The hard landing is taxes aren't going to be settled for a while. The tariffs could go another few iterations in terms of what it looked like. And one of the big points is this uncertainty and this volatility is mentally taxing on investors. Yeah. And you actually have a question about what is the risk that investors are underestimating, how exhausted they're going to get from all this, and how possibly complacent so from a yield standpoint, we continue to be neutral. We don't think it's really time to go. Our conviction level is not really that high to go either way.
When Liberation Day occurred and you had the risk-off trade stock sold off and there was concerns this could produce, let's say, recession. GDP in the first quarter was minus 0.3%, but that was because of the huge surge in imports. So that made the negative contribution from that cylinder kind of wipe out the positive gains. Real final sales to private domestic purchasers. Don't want to get too technical, but it's important because it's an underlying statistic for demand in the economy. Is just consumption and investment. That was plus 3% in the first quarter. So when you're looking at what the 10-year Treasury yield did, it went right around to 4%. And what we would be discussing and telling clients is 4% is not priced for hard landing type of recession. That's more where you get that 3.5% number that we were talking about. Where you are now, a little bit over 4.5%, is that we're seeing signs that, okay, sure, we were minus 0.3%, but we had a good jobs number. Jobless claims, one of the 10 leading economic indicators, is about 100,000 below where it normally has been over the last 40 years before a recession. So we're not seeing the kind of numbers that would suggest a hard landing per se. And then you throw in some of the noise from what we've seen with the tax bill, some concerns. So, a reference point, I think, for us would be if you saw continued strength or resiliency in the economy and some of these concerns you're seeing on the deficit side of the equation now, does the 10-year trade in a 4.5% to 5% range or 4.25% to 5%, where you've eliminated that 4%, 3.5%? And I think that's where we're kind of at right now.
It's not likely to go very much further down from now on.
Data permitting.
Data, tariff, tax, you name the number.
So that is one of the hallmarks of this normal rate setting. What has come with it is a visible increase in volatility in the bond market. So the MOVE index, which is the VIX for the bond market, is visibly elevated from where it's been, say, on a 10-year basis right now. So that's what you're seeing, this huge moves. I mean, we were joking before, seasoned or things like that, right? Moves of 20, 30 basis points in the 10-year Treasury didn't usually occur in a day or two.
So you mentioned volatility in the bond market. Do you think this is a structural shift or it's just transitory?
There's the T word, right? You had to bring that into the conversation.
I think there have been a lot of new players added to the Treasury market. And some are humans, some are bots. And there's a lot of algorithms that are trading. One of the things that came out of the global financial crisis is it really restricted the ability of the banks, the dealers, to act as shock absorbers by taking bigger positions. And I think one of the hopes is that they will allow that adjustment to happen. So you see, it's not transitory, it's evolution.
You think the SLR, the restrictive, comes down, then do you think more market makers can come into the bond market?
It just provides some lubricant from the market, right?
Yeah, it should help.
Despite these kind of efforts, what do you think about some are saying that Treasury bond is more and more being less of a hedge to the risk assets. Many are just leaning to gold, maybe Bitcoin, rather than Treasuries because it's becoming too much volatile.
I don't know if it's the volatility, because the volatility, if it goes in the right direction, acts as a pretty good hedge. But I do think when you have markets that have more of an inflation uncertainty, Treasuries tend to be a little bit better, less of a hedge. When there's a traditional risk-off environment, and when there's some yield that actually you're compensated for it, lengthening it out and taking some duration on it is usually pretty helpful in a risk-off environment.
If there's a risk-off environment and you are looking to the Treasury market, and typically you would feel a risk-off environment isn't something that's going to be long-lasting, it's usually more of a short-term type of phenomenon, that you would see more money gravitating to shorter dated maturities. And I think that is still intact. The 10-year, the 30-year, to Rick's point, maybe that's a little less certain than it used to be, but I think the hedging for front-end treasuries remains in place. We have what is not a relatively new product, but for investors is a relatively new part of the Treasury offerings are Treasury floating rate notes. And they were introduced in 2014. Yes, Treasuries have their own floating rate notes. So 100% Treasuries. There's no corporate exposure, there's no financials like you see in more of the traditional floating rate products. This is strictly all Treasuries. And the floating rate mechanism, instead of being LIBOR or SOFR, is the weekly 3-month T-bill auction with a spread, right? So all you have is 1 week duration. And this is going to be based upon a 3-month T-bill, not speculation. So when you're looking at Treasury floating rate notes now, you know, they're almost 4.5% with 1 week in duration. So what does that do? It creates this interest where you are getting the yield, but not the volatility. This has become a very popular, what we have seen in our experience, a very popular solution for U.S. investors and even for offshore investors as well.
Again, to go back to your April outlook, you said that a recession remains avoidable as the base case, but you also acknowledge rising probabilities of downturn. So what is the biggest factor that has increased the likelihood of recession?
The things I'm looking at are, and the focus on the job market and the housing market.
When you say housing market, is it like the home sales or mortgage?
Home sales, home permits, just the momentum within the housing market. And because, you know, within the U.S., and I don't have official numbers, but your investment worth is probably under, for most Americans, is less than the amount of money they have invested in their houses. So it really gets directly to the pocketbook of consumers. There's a lot of things that could go wrong and tip us into recession, as there always are. Avoidable is always a good phrase, because we were really doing well until we've sort of inserted a transition period. And that transition period, if it goes well, you know, I mean, we could sustain the expansion.
That's the important point, I think, that Rick said. How was the economy prior to, let's call it, Liberation Day again? Now, some people say, oh, that's looking in the rearview mirror. Well, yeah, it is, but it's important that wouldn't you rather have an economy on relatively solid footing going into these unknowns and uncertainties versus one that perhaps was cooling or slowing? And I think that's an important aspect to all this, that the economy was doing okay prior to this. So then that hopefully there's a shock absorbing effect to what could be some of the negatives that we see down the road. And ultimately speaking, and what the Fed is obviously focused on with their dual mandate on the economic side, is the labor markets. And if the labor markets continue to perform, jobless claims, going back to that, as they've had, that would be why that's our base case. I think if you were to see, to Rick's points, some cooling or slowing in labor markets and the housing markets, that's when things begin to shift in the dynamic. And so far, fingers crossed, we've avoided that.
Yeah.
But I think overwhelmingly the prospect of a policy mistake has risen, right? I mean, I don't think we have the level of conviction that in the resiliency, as we once said, you talked about American exceptionalism. I think we're at the point that we need to, even though that term, I don't think either of us would use that term, but I think those who would use it as a carrying card need to justify that now. Because some of the steps we've taken have very little to do with the exceptional policy, exceptional approach. Yeah, so that's going to be the struggle over the next few years.
Yeah, I was just going to say, I think one thing's interesting as well is that there has been a lot of focus on the declines in some of the surveys for consumer sentiment, consumer confidence, right? Our experience has been more, watch what the consumer does, not what they say. And that's why it comes back to the labor market. You still have your job, you're still getting your paycheck. You may be still living your life the same way on May 22nd as you were on April 1st before Liberation Day, right? And I think that's what's important, that, you know, you could ask the question, because of the negative headlines, the market moves, that the consumer sentiment may be souring a bit, but is it affecting what they're spending? And so far we haven't really seen that.
The unemployment rate is still
Yeah.
Very low.
Before moving on to Fed, how do you see the tariffs? We can talk about tariffs all night long, but to just think about how tariffs is affecting inflation outlook. Some are saying that inflation is, of course, can be more accelerated because of the tariffs, or some are saying it can come down because of destruction. What side are you on? What do you think is going to happen?
It's interesting that when you look at what is occurring, the focus has always just been on the U.S. I mean, a perfect example was, say, with the European Union. The concept is if we raise our tariffs here in the U.S., that's inflationary. Well, the EU is matching what we're doing here, so isn't that inflationary for them? And so is there an offset so that, it's not necessarily demand destruction? I think it comes down to a lot of what you saw with the US and China, what occurred in their Switzerland, that both sides realize we don't want to be on either side of this. I do think you will see some deals ultimately being made. Does that mean we're going to go back to a zero tariff world? Not necessarily. Does 10% tariffs result in a higher inflationary setting? We'll have to see. When you go back to Trump 1.0, his first administration, he put tariffs in place for China, and there really wasn't any consequential moves in core CPI or core PCE. So
That was very much like
concentrated. Yeah, it was concentrated. It's not like what it is now. So that's why we are where we are, this uncertainty. And same with the economy. We just don't know. I mean, we can go to a textbook and say, well, this is what should happen, but is that what does happen? And that's why the Fed, bringing it back to the Fed, is kind of just sitting back. I know Powell gets a lot of criticism from everybody, not just the president, that it probably is the best thing for the central bank to just sit back right now and wait. And it's not as if the Fed funds rate is at 5.25, 5.5. They already cut rates 100 basis points. We were doing a webinar, and one of the clients on the webinar asked the question that everyone argues monetary policy acts with a lag. So then can't you argue that the 100 basis points in rate cuts, we may begin to see the good effects of that going, right? I think it was a very good and interesting question. No, I think there's potential validity to it. The Fed's starting point now is a full percentage point below where it was as recently as September.
I think the Fed, by cutting 100 basis points last, gave itself some time. They gave themselves some time to take in the data and to be more reactive than preemptive. If you're really restrictive, you're 5.5%, 6%, then if you're really raining down on the economy, and then you have to be more proactive.
right now, it's not that much restrictive to weigh down on the economy.
I was just going to say, so there's been a lot of discussion, arguments even. What is a neutral Fed funds rate? We would probably be in the camp that a neutral Fed funds rate is higher than what the Fed thinks. Right now, the Fed is what, right around 3%?
Yeah.
I think, what a neutral Fed, that it could be 3.5 or 3.75 in this new rate environment, this back to normal rate environment. So that would mean a 4.25 Fed funds rate is mildly restrictive. It's not very restrictive.
Yeah, and I think there's a case to make. They're not sure where neutral is. And I think if you just do a back of the envelope and just say, okay, their target's 2% inflation, and you want to earn some kind of real yield over inflation, and around 2 to 2.5%, that's sort of where you want to be. It's still attractive as an investment opportunity, and you're earning some rate above inflation. So I think over the long term, this is about the level where we could see rates on through a cycle average.
So your baseline scenario this year, 2 rate cuts, does that still hold?
Yeah, one or two. I think that's fair. I mean, the Fed is in that mode where their dot plot, which is a horrible predictor, as well, has too. I think that's a reasonable case scenario. I think when you look at Fed funds futures 4 or 5, that's not reasonable. And what was interesting, we had a couple of comments from Fed officials just this past week, and one I believe was the New York Fed president, who, when we look at Fed comments, he's one of the 3 that kind of speaks to official Fed policy. He seemed to be suggesting September. So if the Fed's not even going to really consider cutting rates, data permitting, until September, you're running out of Fed meetings as well. There's only so many in a year. So that's why I think that probably makes the most sense. And 375, that's 2 rate cuts, right? 4 1/4, 4, and then 375. So I think there are members of the Fed who feel probably something closer to 375 is neutral.
So last question. Many Korean investors are heavily exposed to long duration UST through TLT and the kind of ETFs. How should ETF investors approach bond exposure, definitely compared to direct bond investing?
First, ETFs provide one trade, diversified access. And so I think it's really democratized, and what we've seen is tremendous growth in model portfolios, ETF models of ETFs. And 4 to 5 fixed income ETFs can give you a diversified exposure with plenty of flexibility to implement views. And so with 5 trades, you can get an entree to the entire fixed income market.
What would you recommend if that's permitted, aside from TLT, fixed income ETF?
Well, our high conviction idea in fixed income has been a barbell strategy. And on the one side of the barbell would be Treasury floating rate notes, where you're getting that income without the volatility. And then maybe you increase duration somewhere else to bring you more in line with core, right? Core duration. Going long duration has been an ineffective strategy. Many times you see the flow of money moving in, and I think there's a lot of regret on that.
Yeah, I think in terms of the TLT investors, and not the fund itself, but long Treasury investors, right now you're getting about 40 basis points over the 10-year for being out in the 30-year area. You're taking on so much duration risk. You have to have the greatest conviction that rates are going to fall by investing, because you're not getting compensated for yield and you're taking on a ton of risk, 20 years of duration risk, interest rate risk, which means, you're going to get absolutely crushed if rates rise.
Which is a similar concept with Treasury floating rate notes. I said before, they're right around 4.5%. So it's a similar dynamic, but here you just have 1 week in duration. So it's the law of diminishing returns that you are taking on, in our opinion, too much risk by moving too far out and something like that. Yeah.
Thank you so much for your precious insights.
Sure. Thank you. We appreciate it.